Welcome back to Deal Camp. We're talking about financial statements, and today it's all about the P&L, the profit and loss, the income statement. And why? Because if you understand this really well, you can do some really interesting things to help you and your company or whatever you're trying to accomplish within a business make more money, keep more money for yourself. So let's get into it. Okay, so we're talking about the P&L. And this is the first of 3 financial statements that if you go get a degree in accounting, if you go become you want to be a CFO one day, if you want to be a great deal maker and buy businesses, these 3 financial statements are going to come up over and over and over and over again. And they are the core 3 financial statements of all financial analysis and accounting. So we're starting off with number 1. I'm going to walk you through a quick example of what all these terms mean, and then we're going to talk about an easy way to understand this that kind of weaves it all together in a way that most normal people who are not experts in accounting can think about and be able to pull up at a moment's notice. So let's get into it. So we have a company that sells lemonade. We sell lemonade. We got a lemonade stand. And in this scenario, we've gone out and we've sold 20 cups of lemonade at $5 a piece. And I'm going to show you how all of this flows into a P&L statement to make it really simple. And so let's imagine 20 cups, $5. And $2 of what you earn for each cup goes to sugar, water, and cups, just to keep it really simple. And then we rent our table, pitchers, and a corner in our neighborhood by the cul-de-sac for $35 from our big brother, because our big brother's a capitalist. And so here's what it looks like on a P&L whenever it flows through. You've sold 20 cups for $5 a piece, so 20 times 5. And you've got 20 cups times $2. That comes to $40. This is a 40% cost of goods percentage of revenue. And that leaves you with a gross profit of $60, right? So this is what you might call contribution margin here. So we have about $60 that we know is available to pay our overhead for all of our rent that we're going to pay to our big brother, which means that it leaves us with net income of $25. So if you didn't have anybody that you gave terms to, like everybody paid you cash, whenever you hand them a cup, they pay you cash, and you're not carrying any kind of inventory, you don't have you don't own the fixed assets of the tables and the chairs that you might use or the corner, then if you started with $0 in your bank account, at the end of this, let's say that this is a month and every Saturday we spend a couple of hours out on the corner and we make some money, and so over that month your bank account would go from 0 to $25. So this is not if none of those other stuff that happens on the balance sheet, that you have those things in your business. Okay? So how do you think about this in a really simple way that you can carry around with you for as long as you live and understand what your job is whenever managing a P&L, right? And think of it like this, as a series of flows and funnels. So you have some streams of income, and then you have funnels that the money flows through that prevents money from continuing down what you might call a waterfall onto the balance sheet and making it into your operating account. So you have leads, and everybody kind of understands who's in business. Most of them understand the concept of a sales funnel. Leads come in the top and they go through a series of stages. They become aware of your product. They learn a little bit more about it. Maybe they get on a sales call or they do a demo. and then they end up making a purchase or not. They either fall through the funnel and buy something, or they fall out, right? So not all the opportunity dollars that go in the top fall out the bottom. And it's the same thing with every step of the way with your P&L. So you've got leads that have converted into sales, and this is where the P&L begins. So you've turned money, opportunity into money whenever you sell a widget. So you've earned dollars, right? This is also called gross income, okay? And then it immediately flows into this first funnel called cost of goods. People call it COGS. It's also called variable costs because these vary with every dollar that you sell. So if you sell more cups of lemonade, then you spend more money on cups, right? And then you also spend more money on sugar and water, right? And lemons. So these are things like the cost of the job materials or the widget materials, any kind of commissions that you might pay. Those commissions get earned at the moment that you earn that sale, that you earn that money. Things like freight, things like that. And so that's your first funnel. And then you move on to the second stream. What's left over after that first funnel is called gross profit. So this is the second funnel, and we also call this contribution margin because it contributes to fixed costs. It contributes to paying them, right? And the whole goal is to have a lot more contribution margin than overhead because that creates a lot of money that can go into our cash account, right? So you've got contribution margin, and that immediately flows down to this next pesky little funnel called overhead. They also call it fixed costs. And this is things like salaries, utilities, if you have software subscriptions, taxes, anything that's you can predictably say, this is going to probably be in this range, whether or not sales go up or down in the short term. So you can hire more people and those fixed costs can go up, right? You can renegotiate your insurance and that could go up or down, right? But relatively speaking, those are pretty fixed. And then once you get through this, you're at what we call net income or the bottom line. And that's whenever it flows through this magical portal to the balance sheet. And then depending on the type of business that you have, all sorts of things happen before the cash actually winds up in your operating account, if it ever does, right? So this is the funnel that we use. It's a really simple way to understand what you're supposed to be doing. You notice that in sales funnels, they have these little knobs. You tweak the funnel. You're trying to gain the metrics, right? If you have an e-commerce website, you want to increase the conversion rate. You want to reduce the bounce rate off your website, right? It's the same thing with each step, each funnel in the P&L. Within cost of goods, you want to be tweaking things so that this number gets lower, right? If you can. It either gets lower or it contributes to a lot more net income at the bottom. So there may be things whenever you may spend more money up here, it may reduce the money down here, and that may contribute to a lot more money down here. But this is all a big equation that you've got to think about and tweak each step. Same goes with fixed costs. And so if you can reduce the amount of overhead that you carry to increase the amount of net income that you have, that creates value. So you're thinking about these the same way that you think about funnels for sales and marketing. Tweaking the funnel to maximize net income. So that's a quick overview of it. I hope that this was helpful. You've learned a little bit about revenue. This is whenever you earn money from selling a widget. Cost of goods, this is the cost of actually delivering that widget, that one additional widget, the marginal widget. Gross profit is what contributes to pay your overhead. And then your overhead is everything that's salaries, payroll, all of the fixed costs that maintain the system that allows you to generate revenue. And that gets you to net income. before you flow to the next financial statement, which we'll see in the next video about the balance sheet. So, hope that helps. See you soon.